Hi, I'm Jamie Turney from Lawrence, Kansas. Welcome. Thanks for joining me for Types of Policies. We are talking about the actual permanent cash value policies that are called flexible whole life policies. The four types we're going to cover today are adjustable, universal, a variable policy, and also an equity index. First, with adjustable. Just like the name implies, the client has some choices or adjustments that can be made while they own this policy. They actually can change the premium paying period, and they can even move between a term policy and a permanent policy. In these policies, the client gets two of those choices, and the insurance company gets one of those choices. Also, proof of insurability will probably be required if more risk is taken with a change throughout these policies. The next type of policy we're going to talk about is the universal life policy. I like to call this a combination policy because it actually does combine term insurance and a cash value plan. Term insurance in this policy is actually annual renewable term. And just for a review, remember that means that the price is going up every year based on that client's age. Also, the cash account is available to them and has some of those same features, the opportunity to earn an interest rate, the opportunity to borrow, etc. Take a look at the chart behind me and you'll see exactly how a universal life policy works, but let's walk through it together. Let's say, for instance, you have John who owns a $100,000 policy and he starts this policy when he's 25. His planned premium is $100 a month. With a universal life policy, the first amount of money that comes out of that premium is the insurance cost. And in John's case, it's $25. But do you see that column in the middle? That's called the expense charge. And those expenses are paid directly to the insurance company. In this case, those expenses are $5 every month for John. So that leaves $70 to be deposited into his savings account, which is fine. He's sending $100 and he has enough to cover all of the cost of insurance, the expenses, and has some for his savings account. But remember, this is annual renewable term. So as John's getting older, the price is going up. And by the time he's 45, the cost of his insurance, his $100,000 policy, is actually $90 a month. Those expenses also go up. For this month, it's $10 a month. Remember, John's planned premium is $100, so he has no money going into his savings because he only has enough to cover cost of insurance and the expenses to the insurance company. And the price of this policy continues to go up because it's annual renewable term. By the time John is 65, his policy is $175 just to cover the insurance plus those expenses at $20 a month. We are in a negative state for the cash value. No money's going into the cash value, but now money is being pulled out from the cash value by the insurance company to cover the cost of those premiums and those expenses. So these policies, remember, have annual renewable term plus a cash or a savings account. Also with these policies, remember we've talked about that you have the chance with a whole life policy that the death benefit is all that's paid to the beneficiary. But with a universal life policy, the client does get an option. In this option, they can choose option A or option B. That means upon death, does the client want to leave the beneficiary just the insurance amount? If that's what they want to do, they will choose option A. That leaves just the death benefit for the beneficiary. If they'd like to leave the death benefit and the cash value or the savings account, that client will choose option B. It's an easy way to remember it. Option A gives you one, the insurance. Option B allows the beneficiary both the insurance and the savings. The next type of policy we're going to talk about is a variable policy. In the variable policy, the name says it all. Something is varying or changing throughout this policy. It is permanent protection. It does have a guaranteed death benefit, but what's changing is the interest rate that client is earning. They are actually getting the opportunity to earn higher than the contract rate of 2 to 4%. And the way they do this is the client chooses where they would like that money in the savings to be invested. They can choose anything from money markets, bonds, stocks, anything to give them the opportunity to earn a higher rate of return. However, because they want to earn a higher rate of return, that money in the savings is no longer kept in that general account with the insurance company. It's actually kept in a separate account because the risk is being taken by the client on that cash value. But I do want to make sure you understand the death benefit will not go below the insurance that was purchased. It could be higher depending on what that cash account is valued at upon the insured's death, but it will not go lower. So that's a huge benefit with the variable account. The other thing you need to know is this is considered an investment. So the person selling it to you must have a life insurance license and a securities license. And the very last type of policy that we're going to talk about is an equity indexed policy. Again, the name says it all. This is a permanent life insurance policy as well, where the cash value grows at a little bit better rate of return than just your basic whole life policy, but this one's tied to an index, kind of like this S&P 500. That means it's going to have an opportunity to be higher earnings on the cash value. The death benefit will also be linked to that, but this one is not considered an investment. So the person selling it to you does not have to have a securities license. So let's review the 4 types of permanent cash value policies under the flexible heading. Adjustable life, remember, gives that client a lot of choices or adjustments that they can make. The universal life policy provides the client annual renewable term with a savings account. Then there's a variable policy where that interest rate is having the opportunity to vary or grow at a higher rate of return. And then the equity indexed, that one is actually tied to an index like the S&P 500, gives that client an opportunity to earn a higher rate of return than just the 2 to 4% in their contract. I thank you very much for your time. I look forward to seeing you soon.